Okay, imagine this. A company misses its revenue target, right? But then its stock actually goes up and it's had this absolutely stellar year in the market. Kind of makes you scratch your head.
It really does. What's going on there?
Exactly. Welcome to the deep dive. Today, we're digging into Hims and Hers Health and their latest Q2 2025 results. Our mission: to get past the headlines, look at the earnings call, the financials, what analysts are saying, and really give you the deeper story behind it all.
Oh.
We'll explore how they're growing, using personalized care, making these big bets on tech and expanding globally, and also navigating, the financial ups and downs, plus some pretty interesting skepticism from analysts.
It's a fascinating puzzle, absolutely. The market reaction wasn't quite what you might expect from just the surface numbers. Let's jump right into Q2.
Okay, let's unpack that contradiction because,
Yeah.
the numbers looked a bit mixed at first glance. They reported earnings per share, EPS, of $0.17. Now, that was actually better than the forecast of $0.15, beat it by what, over 13%?
Yeah, a solid beat on earnings.
A very solid beat. But then revenue, it came in at $544.8 million, just slightly under the $549.87 million forecast.
Well, that's
Less than a percent miss.
Right, a tiny miss there.
So earnings beat, slight revenue miss. How did the market take that?
Well, this is the interesting part. Despite that small revenue shortfall, the stock reacted positively. It went up 1.31% during regular trading.
Okay.
And then it climbed another 1.49% in aftermarket trading.
Huh.
And if you look at the bigger picture, year to date, the stock's return is, well, incredible, 161.99%.
Wow. Okay, so investors were definitely looking past that revenue headline.
Absolutely. They seem focused on the earnings beat, maybe the growth story, the strategy,
Oh,
something deeper.
That's a really strong signal then. Let's dig into those financials a bit more. The gross margin, for instance, it dipped. What happened there?
Yeah, good point. Their gross margin for Q2 was 76%. Now, that is down from 81% in the same quarter last year.
Okay, why the drop?
The company mainly pointed to the increased contribution from their weight loss offerings. Basically, the cost of goods, especially for the compounded meds in that category, is higher. So it seems like they're making a strategic choice here, prioritizing gaining market share and locking in customers in this huge high-demand weight loss area.
So accepting a lower margin now for potentially bigger gains later.
Exactly. It's a trade-off. They seem willing to take a slightly lower gross margin for what they hope will be a much larger, stickier customer base and more overall revenue down the line. It signals a shift as they expand into these newer, maybe higher-cost specialties.
Right, a strategic play. But did that impact the bottom line overall? I mean, did profits still grow or did these costs eat into them?
But profits definitely grew. Far from eating into them, net income absolutely soared. It hit $42.5 million.
Wow.
Yeah, that's up a massive 220% compared to last year.
220%.
And adjusted EBITDA also more than doubled, reached $82.2 million, up 109% year over year. That translates to a pretty healthy 15% adjusted EBITDA margin.
Okay, those are seriously strong jumps in profitability.
Very strong. It shows that even with that margin shift, the sheer scale and the growth are really driving impressive bottom-line results.
Okay, strong profits. But I did notice something else digging in: negative cash flow. How does that work with such high net income and EBITDA? Seems counterintuitive.
Yeah, that's a good catch. Net cash used in operating activities was indeed negative $19.1 million, and free cash flow was negative $69.4 million.
So what's the explanation?
The company explained it was mostly due to temporary things, working capital investments and increased spending on their pharmacy infrastructure, capital expenditures. They actually said they expect this to normalize and turn positive again in the second half of 2025.
Okay, so it's not an operational problem. It's more like they're investing heavily right now.
Precisely. It looks more like a reflection of strategic investment to build out their capabilities for the future, not a sign of underlying trouble.
Got it. So looking at their overall financial health then, are they well positioned to actually pull off these big plans? What's the balance sheet look like?
They seem quite solid there. They ended Q2 with over $1.1 billion in cash and short-term investments. That's a hefty cushion.
Okay.
They do also have about $1 billion in debt, mostly from that convertible note offering back in May.
Right, the convertible note. Can you quickly explain what that means for people?
Sure. It's basically a type of debt that can be converted into company stock later on if certain conditions are met. Growth companies often use them because the initial terms can be more favorable, and it potentially delays diluting existing shareholders.
Okay, so that big cash position gives them options.
Definitely. It provides a lot of flexibility to invest in growth, whether that's organic or through more acquisitions.
And I also saw they have a share buyback program running. What's the thinking there?
Yeah, they've got $65 million left on a $100 million authorization that runs through August 2027. The idea is twofold, really. One, they can buy back stock if they think the market price is too low, capitalizing on what they see as a disconnect.
Right.
And two, it helps offset the dilution that happens from stock-based compensation. When they give shares or options to employees, it increases the total share count, so buybacks help counteract that effect for existing shareholders.
Interesting. Okay, so a pretty solid financial base, lots of investment happening. But let's talk about what's really driving the growth. The CEO, Andrew Dudum, he talks nonstop about personalized care. How is that actually working on the ground to bring in customers?
Yeah, you're right. Personalization is absolutely central to their whole strategy. You see it in the numbers. They grew subscribers to 2.4 million.
2.4 million. Wow.
Yeah, that's a 31% jump year over year. And here's a key stat. Nearly 70% of new subscribers in Q2 specifically chose a personalized treatment plan.
70 cent right away.
Right away. The CEO really hammers this home, saying their model is, quote, centered on the individual, not the system, trying to make precision medicine something everyone can access.
That's a compelling pitch. How many customers overall are on these plans now?
It's substantial. Almost 1.5 million customers. That's over 60% of their entire subscriber base.
Over 60%.
And that number has more than doubled in just the last 2 years. So clearly, people want this personalized approach. The adoption is rapid.
So what does that mean for you, the customer? What are the actual benefits of getting a personalized plan versus just a standard one?
Well, it offers quite a few things. For example, dosages can be customized to, balance effectiveness with managing side effects.
Okay.
You might get alternative forms that are easier to stick with, like they mentioned, biotin plus minoxidil gummy for hair loss,
Uh-huh.
easier than, say, a topical solution for some.
Makes sense.
And they can create plans that address multiple conditions at once, simplifying things if you have several health needs. And the data backs this up. The number of subscribers using personalized plans for multiple conditions shot up 170% year over year, over 500,000 people now.
That multi-condition aspect is really interesting, a more holistic view.
Exactly. That seemed to be the goal.
Let's zoom in on weight loss. That seems to be a huge driver for them. How is personalization working there, particularly with the GLP-1 treatments everyone's talking about?
Yeah, weight loss is definitely a prime example. Customers who were on personalized GLP-1 plans for 6 months reported losing an average of 10.3% of their body weight.
That's significant.
It is. And importantly, the majority said they had either no disruptive side effects or only ones they could easily tolerate.
And GLP-1s, just quickly, those are drugs like semaglutide?
Correct. Semaglutide is probably the best known example. They help manage weight and blood sugar. But here's what's maybe even more impressive. The retention.
Ah, keeping people on the plan.
Right. Only 25% of people on these personalized GLP-1 plans stop treatment within 6 months.
Only 25%. That sounds low. How does that compare?
It compares very well. Some public studies have shown discontinuation rates for GLP-1s closer to 80% in that time frame.
80% versus 25. That's incredible retention. So they're not just getting customers, they're getting them to stick. That's huge for a subscription business, right? Especially in healthcare.
It absolutely is. Adherence is critical.
So what's their secret sauce there? How are they achieving that?
They point to a few key things. One, frequent access to providers. The average customer has like 6 interactions in just the first 3 months.
Okay, lots of support.
2, what they call white glove customization.
Hmm.
Providers can tweak dosages based on how someone is responding, managing side effects, optimizing results.
Mm-hmm.
And 3, the app. They have tools in the app, water intake trackers, calorie counters, clear instructions that really help people stay engaged and manage their treatment. Apparently, about 90% of their weight loss subscribers actually download and use the app.
So high-touch support combined with tech tools. Makes sense. It sounds like they're building out a whole ecosystem, not just selling meds.
That's definitely the impression.
So what's next? Are they launching new things to keep building on this personalized health idea?
They are. There's several interesting things on the horizon. First up is hormone health therapy.
Okay, what does that involve?
Personalized plans for men dealing with low testosterone and also for women going through menopause, tackling things like hot flashes, mood swings. They estimate these conditions affect over 50 million Americans, and often kind of fall through the cracks in traditional healthcare.
Yeah, definitely underserved areas. How are they going to support that? Do they need new capabilities?
Yes, and that leads to another big move, lab testing. They recently acquired a blood testing lab.
Ah, bringing it in-house.
Vertical
Yeah, they
integration.
want to control that process. Initially, it'll support the hormone health launch, but the plan is to eventually offer lab testing as a standalone service too.
Their goal, they say, is to empower customers. Give them accessible, standardized tests so you can understand and optimize your own health. Not just see if you fall within some generic normal range, but aim for optimal health.
Moving beyond just normal to optimal, that's a shift. So where does this all lead long term? What's the big vision?
Well, looking out to 2026, they're talking about integrating the lab work with their compounding and peptide facilities to offer, get this, longevity-focused care.
Longevity, like anti-aging.
Sort of, more like proactive interventions for longer, healthier lives, focusing on things like immunity, recovery, metabolic function. The CEO actually described a big vision shift, transforming the platform from a place you go to treat issues to a place you go to prevent them.
Preventative healthcare, okay.
And he even threw out this analogy, potentially becoming a kind of Costco-like healthcare membership.
A Costco for healthcare, that's ambitious.
It definitely paints a picture of broad access and value, doesn't it?
Yeah.
It certainly does. Wow. Okay, to achieve that kind of ambition, the technology must be critical. What are they doing on the tech and AI front?
Absolutely central. They brought in a new chief technology officer, Mo El-Shinawi. His whole mandate is to make Hims and Hers a technology-first healthcare platform.
Technology first. Okay, what does that mean in practice?
They're focusing on a few key areas. One is building a unified data and intelligence platform that's meant to improve personalization even further, but also automate things like fulfillment and inventory management.
Makes sense. More efficient.
Two, they're investing heavily in AI-powered personalized agents. Think 204/7 support, more engagement through AI.
AI agents for support, like chatbots, but smarter.
Presumably, yeah. More sophisticated, more personalized. And three, they're building a global-ready tech architecture to support that international expansion we talked about.
So can we expect to see this AI stuff making a real difference for users anytime soon?
They seem to think so. They're talking about seeing immediate improvements in efficiency and engagement within, like, the next 3 to 6 months. Really, what kind of things?
Things like on-demand AI nutritionist agents you could chat with, or AI-driven cognitive behavioral therapy tools for things like sleep, right within the app.
Wow, okay. So embedding AI directly into the user experience.
Exactly. Enhancing the whole journey, making it more supportive, more intuitive.
Okay, and you mentioned global architecture. Let's talk expansion. They've been busy there too, right?
Very easy. The big news was the acquisition of Zava back in July.
Zava, right. They're a European player.
Yeah, a leading digital health provider in Europe. This deal massively expands Hims and Hers' footprint in the UK and gives them infrastructure in Germany, France, and Ireland too. That's a combined population of about 160 million adults. So a huge new market.
And what's the immediate impact of that deal?
They expect Zava to add at least $50 million in revenue just in the rest of 2025 and do it in a positive adjusted EBITDA margin. So seems like a relatively quick financial contribution.
That's a significant European entry. Anywhere else on the map?
Canada is next on the list. They're planning to launch there in 2026.
What's the plan for Canada?
They're starting with a holistic weight loss program featuring generic semaglutide, timing it for when that's expected to become available there. And pricing seems key. They're aiming for $7,500 a month compared to maybe $200, $400 for the branded stuff. That could be a big deal, especially since they noted like 2/3 of Canadians struggle with weight.
Yeah, that price point could be very disruptive. It really sounds like international isn't just a side project for them.
Not at all. Their long-term view sees international markets as a potential multi-billion-dollar annual revenue stream. They're even talking about potentially looking at Latin America and Asia down the road. It really underlines their belief that this consumer-focused, digital-first healthcare model can work pretty much anywhere.
Okay, a lot of ambition, a lot of moving parts. Let's bring it back to the near term. What's their outlook for the rest of this year, and what are the potential bumps in the road?
Well, they reaffirmed their guidance for 2025, which usually signals confidence.
Okay, what are those numbers?
For Q3, they're projecting revenue between $570 and $590 million. That's still strong growth, 42-47% year over year. And adjusted EBITDA of $60 to $70 million.
And for the full year?
Full year 2025, revenue guidance is $2.3 billion to $2.4 billion. That's 56-63% growth. and adjusted EBITDA between $295 and $335 million. They also specifically called out the weight loss specialty, expecting it to bring in at least $725 million in revenue this year.
Those are still really strong growth numbers, especially for a company reaching that kind of scale, but are they acknowledging any challenges, any headwinds?
They did mention a few things. One is that decline in monthly average revenue per subscriber, ARPS, which went from $84 down to $74.
Right, why did that happen?
They said it was partly due to offboarding some GLP-1 subscribers who are on commercially available dosages, and also a deliberate shift in their sexual health category towards more premium daily use products. That might cause a dip initially, but they think it'll lead to better retention long term.
Okay, so some transition impacts, or what else?
Regulatory changes are always a factor, especially with GLP-1s. They mentioned a shift in fulfillment from what are called 503B facilities to 503A facilities now that drug shortages have eased.
503B versus 503A, what's the difference, basically?
Think of 503B as large-scale outsourcing facilities regulated by the FDA, often making bigger batches. 503A are more like traditional compounding pharmacies, making patient-specific prescriptions. So the shift suggests more customized compounding. It might mean shorter shipment cycles, maybe lower revenue recognized per individual order. Even if the underlying demand is still strong, it's more complex logistically.
Got it. And competition.
Yeah, they acknowledge that too. It's definitely a competitive space, personalized healthcare, lots of players emerging.
Okay, so strong guidance, but some known challenges. Now, the really interesting part you mentioned earlier, the analyst sentiment. Given everything we've discussed, the growth, the strategy, the profitability, you'd think analysts would be pretty bullish, right?
You would think. But here's that major disconnect we talked about. It's quite striking. Market Beat data shows the consensus rating from 13 Wall Street analysts is actually reduce.
Reduce, not buy or even hold.
Reduce. To break it down, only 2 analysts have a buy rating, 8 have a hold, and 3 actually have a sell rating.
Wow, okay. And what about their price targets?
The average price target from these analysts is $39.83.
$39. But the stock is trading around $63 right now.
Exactly. That average target suggests a potential downside of over 37% from the current price.
That is a massive gap between the company's performance and outlook and how analysts are valuing it. What could possibly explain that disconnect?
It's the million-dollar question, isn't it? It's really intriguing.
Yeah.
While the company is painting this picture of strong execution and a huge long-term vision, analysts might be looking more critically at some of the things we discussed. Maybe the negative cash flow, even if temporary, the heavy capital spending on labs and infrastructure.
Cost of all that growth.
Right. They could be factoring in the long time horizon needed for these big bets, international expansion, vertical integration to really pay off. Plus, you have the intense competition, especially in weight loss, and the ongoing regulatory uncertainties around GLP-1s.
So maybe they see more risk in the execution.
Potentially. Their reduced consensus could just reflect a more cautious stance, given those execution risks and the competitive landscape. Even if they acknowledge the company's vision is compelling, they might just think the current stock price has gotten ahead of itself.
Fascinating stuff. So wrapping things up, it's been a really dynamic Q2 for Hims & Hers Health, hasn't it?
Absolutely.
We've covered a lot. Beating EPS, strong subscriber growth fueled by that personalized approach, huge investments in AI, labs, and that big push into Europe and soon Canada. You've really seen how they're trying to shift healthcare from just reacting to problems to actively preventing them.
Yeah, and what really stands out, as we just hammered home, is that stark contrast. You've got the company's solid performance, these ambitious plans, the positive market buzz, and then on the other side, this cautious, almost bearish consensus from the analysts pointing to potential downside.
Right. It highlights how different people can look at the same company, especially in a fast-moving sector like digital health, and come to very different conclusions about its value.
It really does.
Yeah.
Are they focusing on the vision or the immediate execution hurdles? Long-term potential or short-term costs?
So here's something for you to think about. If this Hims & Hers model, personalized, app-driven, focused on prevention, really is the future of healthcare, what does that mean for everything else? For traditional doctors' offices, hospitals, even health insurance? How might a shift like this change your own healthcare experience down the line?
That's the big question, isn't it? What ripples does this create across the entire system? Lots to consider.